All right, let's talk about Microsoft. If you follow tech or finance at all, you already know they're an absolute juggernaut. But, when a company reaches an unprecedented market valuation, we really have to look past the flashy headlines. So, in this explainer, we're going to unpack a massive September 2025 equity research report. We're digging right into the raw financial data, checking out the competitive landscape, and uncovering the hidden strategic bets to see if reality actually matches all this hype. To make sense of all this dense data, we'll quickly tackle 6 key pillars today. 1. The $3.7 trillion question. 2. Valuation. Is it a premium or just overpriced? 3. The cloud and AI engine. 4. Expanding their European footprint. 5. A year of volatility. And 6. The final verdict.
Okay, let's jump right into Section 1, the $3.7 trillion question.
$3.7 trillion. Let that sink in for a second. This staggering market cap positions Microsoft literally at the very center of global digital infrastructure. They are no longer just a software company. They're the underlying plumbing for modern enterprise. But here's the catch. A number this massive leaves absolutely zero margin for error, especially with today's global macroeconomic uncertainties. So how on earth did they get here? Believe it or not, it actually starts with the people. Now, despite some recent internal friction, specifically over a new 3-day-a-week hybrid work mandate and, unfortunately, multiple layoffs, CEO Satya Nadella's ongoing focus on cultural renewal remains a totally critical foundation for their financial success. He famously shifted Microsoft from a rigid know-it-alls competitive culture to a learn-it-alls mindset, one built on collaboration and empathy. This cultural pivot is a big deal. It repositioned them as a collaborative leader in the AI era rather than just an isolated monopoly.
Moving on to Section 2, valuation, premium or overpriced.
To figure out if Microsoft is actually overpriced, we rely on something called relative valuation. Basically, we need to see if investors are paying a premium for Microsoft's future earnings when we compare them directly to their closest rivals, like Apple or Alphabet.
And the takeaway here is striking. Microsoft trades at an elevated price-to-earnings multiple of 36.73. Compare that to a peer like Alphabet, which is trading at just 25.67. And a very clear story emerges. The market isn't just paying for what Microsoft is doing today. No, they're paying a steep premium for what they expect these massive AI and cloud investments to yield tomorrow.
Placing Microsoft alongside other tech giants like Apple, Oracle, Alphabet, and Adobe really reveals a fascinating competitive landscape. Just look at their robust $101.8 billion trailing 12-month net income. That's huge. While Apple might boast a higher return on equity, Microsoft is managing to balance its massive $3.7 trillion scale with highly profitable margins. This completely justifies their premium through widely diversified operations and, honestly, unparalleled cloud leadership.
Which brings us to Section 3, the cloud and AI engine.
When you break down their revenue, you'll see a massive 39% chunk dedicated entirely to server products and cloud services. Azure is undeniably the beating heart of their business model right now. You can basically forget Windows as the main driver. We are firmly living in the cloud era. In Q4 alone, Microsoft Cloud revenue climbed 27% year over year, and that was heavily driven by Azure's stellar performance.
And listen, this cloud dominance doesn't just happen by accident. It's fueled by an incredibly aggressive research and development strategy, funneling over $25 billion annually into AI integration and platform conversions. $25 billion. They're just pouring money into rapid iteration, scalable deployment, and deep integrations of artificial intelligence across their entire product stack.
All this multi-billion-dollar investment translates directly into real-world applications. As highlighted in a recent Microsoft 365 broadcast by Andrea Lum, tools like Copilot are completely transforming enterprise productivity. By integrating generative AI capabilities at scale, from GitHub all the way to standard Office applications, Microsoft isn't just selling software anymore. They're positioning themselves as a critical enabler of digital transformation. They are literally changing how people actually do their daily work.
Next up, Section 4, expanding the European footprint.
Beyond software, their European strategy is highly aggressive and, interestingly, highly localized. They're expanding their data footprint by a whopping 40% over the next 2 years. But at the same time, they're navigating some very complex regional cybersecurity regulations through localized sovereign clouds in places like France and Germany. They've even appointed a brand new deputy CISO specifically for Europe to ensure they stay compliant with strict laws like the Cyber Resilience Act. Basically, they're guaranteeing uninterrupted cloud operations through what they call a digital resilience commitment. Furthermore, by providing open access that supports over 1,800 different AI models, including a ton of open source options, Microsoft is aggressively empowering European startups and enterprises. So this isn't some closed-off walled garden, it's a massive ecosystem play that's actively cementing Microsoft's tech leadership and economic partnership across the entire continent.
All right, Section 5, a year of volatility. Let's trace this roller coaster of a year. Back in September 2024, they hit a real high with the announcement of a massive $30 billion AI infrastructure fund with BlackRock. But then, fast forward to January 2025, and despite strong earnings, their shares dropped sharply after hours. Why? Because of weaker Azure growth guidance and incredibly high AI infrastructure costs. Then April brought a massive Q3 beat that rallied the stock once again, leading right into July, where resilient Azure demand and a super bold $30 billion plus capital expenditure outlook boosted the stock back near its peaks.
So yeah, the transition to AI operations hasn't exactly been painless. In a company-wide memo, CEO Satya Nadella actually openly described it as messy. To realign costs for this massive AI infrastructure investment, they had to reduce their workforce by roughly 9,000 employees and even close several Xbox game studios. So the intense market volatility we've seen, that's the turbulence investors had to weather to reach today's premium price.
And finally, Section 6, the final verdict. When you pull it all together, the underlying financials remain incredibly strong. There's a steady, undeniable year-over-year climb in both revenue and earnings before tax from fiscal year 2022 straight through to 2025. Despite that messy AI transition and those elevated multiples we talked about, the core business is incredibly healthy. I mean, it's growing at a double-digit rate with operating income up 17% and net income increased by 16%.
Because of this strong cloud growth, their totally dominant AI positioning, and an ever-expanding international footprint, analysts have actually issued a buy recommendation. They've set a yearly target price of $615.38. When you compare that to the closing price of roughly $501 at the time of the report, you're looking at a potential upside of nearly 23%.
So I'll leave you with this to chew on. As macroeconomic uncertainties continue to loom and competitors race desperately to catch up, is this premium valuation a permanent new reality for Microsoft, or is it a precarious peak built on sky-high expectations? The data clearly shows a powerhouse in motion, but the market's patience for this massive infrastructure spending is what will ultimately dictate the future. Keep a very close eye on those Azure numbers, because that is where the real story will unfold.